Well, hello everyone. Welcome back. It's Wednesday evening, and just like every other Wednesday, we're here at 5:30 Pacific time for the Shower Door Professionals live stream. And yeah, we all just kind of get together here every week. We're like shower door nerds, you know? I mean, can you imagine a bunch of people getting together every week to talk about shower doors? Well, imagine it because it's true. It's what we do. And we're mostly business owners. I mean, not every one of us here is a business owner, but I think most of us are. So, there's the shower door business, there's, the glass business, not just shower doors. Sometimes we dabble in some other glass related stuff. But then there's all the business aspects too of being, a glass shop owner or whatever. And it's interesting. Last week we were having a call about benefits, that people offer their employees. And of course, a big part of that is insurance. And you know, we we all have questions, and we try to answer our own questions. And you know, we're shower door people. I mean, what do we know about it? So we're kind of guessing, kind of just throwing it out there. But the cool thing is, I just said, hey, if anybody has somebody that's helping them with their insurance, see if you can get them to come on, and talk to us and fill us in on what's really going on, right? So Adrian Landa was the guy who like took it to task, and reached out to his insurance lady, and that is Debbie Ruiter. And she agreed to come on and talk to us about insurance and tell us what she knows about it, maybe answer some of our questions. So anyway, I'm going to turn it over to Adrian. And if you don't mind, Adrian, just go ahead and introduce your guest for us.
Yes, so this is Debbie Ruiter with Dennis Tierny Insurance Associate Inc. She helps us with our insurance here, our group insurance, and yeah, so I'm gonna just turn over to her and she can explain a little more about her and what she does. And yep.
Okay. Well, hi there. I'm Debbie Ruiter, and as Adrian said, I work with Dennis Tierny Insurance Associates. I want to give you a little bit of background. I am a small shop, like probably many of the glass shops, and a family business as well. I started back in 1995 when I decided that what I was doing I didn't enjoy and joined my dad's business. My dad's history is he had been a life insurance agent who was transferred out to Hawaii and then transferred to San Francisco, where he was the life insurance manager for the Hartford Life at the time. And then decided that he didn't like being a manager and went off on his own and started his own business, which is the company that I have now. He did a lot of business on his own where he became, I think I had said this earlier, he became the life insurance division for a lot of property and casualty firms in the San Francisco Bay Area, Silicon Valley, Napa, and wrote a lot of their insurance. The one thing he didn't do with them, because it would have been competing, was their small group benefits. So when I came on and started working with him, that is one of the areas that I took over and expanded as time went by. From a personal viewpoint, I have a family. I have 4 kids. Our youngest is off at college, just completing his first year. Got to have a couple out in the workforce. But I've also had the experience on the other side of children that have had health issues. So when it comes to utilizing medical plan, I have had to do that. And and that's pretty much where my experience has been. I specialize in small group. I really like working with the smaller employers, employers that maybe don't have HR. Um, I like to feel that we can add more of a boutique type service where we can help assist in ways that, because again, like I think one thing that I've heard is that where do you get started? How do you go about looking for benefits? How do you manage the benefits? And I feel like that's where our company has really been able to come in and do that. Um, And please, if at any point anybody has any questions, please jump right in.
Oh, don't
And if
worry,
there's
we
certain,
will. We'll just pop
okay.
right in.
And if there's certain areas in which you want to hear specifically, please, jump in. I'll go ahead and start with just some different thoughts on major medical insurance. As Adrian said, I have been their medical insurance agent. Now, I think we put in the plan about 2 years ago, Adrian? Um, we put the plan in and we started with just a medical plan. And then as we went through this renewal this past year, we went ahead and added additional benefits, which was a life insurance benefit and a vision benefit. Um, Many of my employers will start with just the medical and then build upon that. I do recommend with many of my employers to offer more than one plan. And again, a lot depends upon group size. Sometimes I'm working with just maybe 2 employees. I have groups that are up to closer to 40 employees. And sometimes the needs for those groups are different. So it really takes, when I go in, it's like, okay, let's get a census. Let's then get a quote for, multiple carriers. And then let's sit down and see what the pricing comes out to be. And then figure out what do we need to do from there. We can review the quote. We can look at the different benefits, at the different levels here in California that they have because they have the metal tiers. And then turn around and decide what is the best way to go. How much is the employer going to contribute for the employee? How much are they going to contribute for the dependents? Um, and that's usually how I kind of take it. I kind of present everything and then we kind of back into it and as to what would be best for the employer. And one thing I always feel is that when you're looking at benefits is that you also need to look at the employer is the owner. You want to make sure that those benefits work for you as well. So for instance, I have a company that is probably now at about 35 employees, but what we found is that 90% of them wanted Kaiser. And it was really hard to have a Kaiser plan alongside another plan because it's the other carriers that wanted all the participation. And the Kaiser plan they didn't care. So we found at that point, Covered California came about. So we ended up putting them in Covered California because we were able to put, the owners and a couple of the other employees wanted more of a PPO and the rest of the employees wanted the HMO. And that has worked well for them for years. So again, it's kind of sitting down and figuring out what is the overall goal, what is the budget, and then how do we make that work. Um, I also work with the company at the time of renewal. And what we do is when after the first year, about 60 days prior, I get a renewal packet and it will tell me how much the premium has gone up. And they usually will break it down by employee and give me a percent. When I look at that, I have to kind of take into consideration, okay, what's happening overall in the marketplace? Is this a time to sit still, even though that there's an increase, or is it a time to maybe make a move and maybe really look at seeing what other pricing is out there? I don't always recommend that an employer move because I strongly feel that every time that you change the plan, it creates a disruption with the employees. And you don't want your benefits to work against you. You really want them to be an asset to either keep employees or to bring in new employees. But I feel that there are other ways that if there are increases, that we can work with that increase and maybe stabilize the cost for the employer. One of the other things I would recommend in the renewal is that if you only offered one plan, is maybe we look at offering two plans. Let the employee kind of choose which level of coverage is best for them. Not all of us, need extra benefits. Now, if it were me, I would be going for the best plan available based upon the experience that I've had. But there's other people that really haven't been to the doctor as much, and maybe they're looking for something a little bit more higher deductible, catastrophic, but they're still protected by that out-of-pocket maximum. And what they also want to do is minimize what they have to pay per month. So I like to offer more than one plan and let the employee choose. Now, how do I stabilize that cost for the employer? There's a couple of ways. One, you could have the employer paying a flat amount for every employee towards the benefit. And there are rules with that in terms of the percentage. Or you could say, okay, I'm going to pick this plan. So say it's a silver level plan. I'm going to pick the silver level plan, and that's the plan I'm going to, as the employer, contribute to. If you want to buy up to the gold level, that's going to cost you more out of pocket. But if you want to go down to, say, a bronze level, you'll still get the credit at the silver level, but you might see a price reduction in the employee's copay.
Mhm. Mhm.
So those are the things that I kind of, and again, it's really sitting with the employer and talking about what works best for them. And some employers just want one plan. They want it as simple as possible. Others are more focused on the cost. But when I am looking at plans, and especially in the beginning, my sister was going through a divorce, and one of the things that her attorney said is, "Don't get caught in the weeds." And I don't know why that has stuck with me, but I think sometimes when we're looking at medical benefits, we get caught in the weeds. We start looking at every single detail of, oh, what's this going to cost me to ride in an ambulance, and what's this going to cost me? When I'm looking at a plan, I'm looking at a couple things. I'm looking at the premium, but I'm also looking at the annual out-of-pocket maximum and my deductible. And is my deductible a part of that annual out-of-pocket maximum? Because whether I got sick or whether I got in a car accident, that out-of-pocket maximum is what is going to dictate how much I am responsible for. And so that's why I say I don't tend to get caught up in all of the others. I really want to know bottom line what I'm going to have to pay. It really, when you start comparing like a gold plan against a silver plan, the out-of-pocket maximum may be the same, but the premiums may be different. And so what you're going to find is that for a plan that maybe has no deductible, I'm going to pay a higher monthly premium, but my out-of-pocket maximum is the same as the silver level plan. It's just, how do you get to that out-of-pocket maximum? So I don't know if, and please, again, stop me if there's any
No, it's
questions along
good.
the way.
Great. You're covering a lot of stuff. I mean, so do you find that, and so in most of these insurance packages,
Mhm.
is the employee paying part of the cost of the plan, or how does it
Yes.
usually break down?
Yeah, so I do not recommend that an employer pay 100% of a premium. And the reason being is that if an employee is married and they have coverage through their spouse, um, and you cover it 100%, you have to automatically put them on the plan because you're covering all employees regardless, where they might choose to go on their spouse's plan if, if they had to pay something out of pocket for your plan. So I recommend, even if it's small, I have one employer that really contributes a flat amount. He's very sensitive to his employees. He feels that the medical benefit is super important. And what he does is he contributes, he has the employee contribute a flat like $50. Like it's minimal. Most of my employers have maybe 80% to 75% is what they have the employee pay of the premium. And then dependence is tricky. I have, probably 50-50. I have half that pay maybe 50% for the dependents and half that don't pay anything. And so that would be 100% cost, out of pocket for the employee to add their dependents. Um, in California, and again, this is where you have to kind of know your own employees. In California, if you as the employer offer benefits and you choose to pay 50% or any percent of the premium for the dependents, that automatically knocks those dependents out of being able to apply for Covered California. And on an individual side where they may pay less out of pocket. So the moment you offer dependents and to pay for, even to let them enroll on the plan at zero coverage where they're paying 100%, you've just eliminated them from being able to apply to Covered California.
Oh, okay. Oh,
So just, yeah. So, and again, it's, I would say most of my employers anywhere maybe 75 to 80% for the employee, and then maybe if they cover dependents, they'd cover 50% for the dependents.
all right. All right. Yeah. A lot of details to be aware of, right?
It definitely is. I think the first year is the hardest because you're really trying to absorb all this information coming at you, and that's just getting started. That's just to get the plan up and rolling and get everybody covered. Because then you want to have, you also have to, you could put in a great benefit plan, but you've got to also get the employees to buy into it.
Mhm.
Um, you have participation requirements that you have to meet with most carriers. And so you need the employees to enroll onto the plan. Now, if an employee has coverage, say through a spouse, and they decline your coverage, that doesn't count against you. But if you have someone that just says, no, I don't want to be on the plan, that will hurt you against, go against your participation. Um, and I also think, it's also to me very important, and I usually see this more, we do this at renewal, is I think the employees need to be aware of what you as the employer are spending. And so oftentimes I will make, for my clients, I will make a spreadsheet. And when I do the individual costs for each employee, say of the renewal and what their rates will be if they go on this plan or that plan, I also show at the bottom what the cost is for the employer each month, and I annualize it because I don't think the employees really understand how much an employer is paying for these benefits. Um,
Great point. Good.
and sometimes I think I've even gone as far as with one company, we included Social Security as well as Medicare, that portion. Um, in terms of other benefits, so you've got your major medical, and then oftentimes an employer will offer dental or they might offer vision. When you start getting into like vision and life, the employer usually pays 100% of that premium, but you're talking a minimal premium in comparison to medical and dental. Um, Dental, again, I have, probably half of my companies offer it and half don't. And I have one employer that has said we're not offering it. But if an employee, I will give every employee up to $1,000 a year if they bring me their receipts for their dental work.
Okay.
And if so, they pay for it out of pocket first, and it's just a reimbursement that they have set up internally, but they didn't go with a formal plan.
Well, that's an interesting option.
It is. I mean, you just want to make sure that you keep the records right, and you just want to make sure that what you offer to one employee, you offer to all employees. Because when you start getting into major medical and like that, you can't discriminate against who can be on the plan and who can't be on the plan. It's really truly based upon the hours worked. So any full-time employee would have to be eligible to go onto the plan and offer the right to go onto the plan. So there's a lot that happens when you start, to get a plan rolling, and then you have the management of the plan. And this is where I feel that a lot of small companies, this is where it's a bit harder because this isn't what you're doing day to day. You have an employee that leaves the company. What do you do? You have a new employee you want to bring in. What do you do? And so I will tend to make packets for new employees so that it will be easy for you to hand the employee, whether it be electronically or paper, where they can see what the benefits would be. And once you tell me what their birth date is, I can give them a pricing. Um, and enrollment now with some carriers isn't by paper. I think United Health and a couple of other carriers, it's all done by an employer portal, where an employee, somebody within the company would have to know how to go in, add an employee, delete an employee, know when the employee needs to be offered benefits, when their application needs to be in by, and the same thing with termination, because once you terminate an employee, and well, in California, you start triggering, a small company would be Covered California. So once you submit that termination notice, the carriers then turn around. Most carriers, I'm pretty sure in California, handle it themselves, but they'll turn around and notify the employees of their right to CalCobra.
Oh, right, right.
So that's not something you have to manage, although I do have one employee that has chosen to have a third party administrator handle that for them because they didn't want the responsibility. But for small group in California, the insurance carriers will handle the termination and then forward the information for them to go on to CalCobra to extend their coverage.
Anybody out there have any questions so far?
I have a question. You mentioned I've heard of them before, but honestly, I don't know what the heck they mean. Um, your basic HMO and PPO.
Yep.
What are those?
So think of an HMO being like Kaiser, right? An HMO is where if there's Kaiser, which is all HMO. You can only see doctors within Kaiser. And then you have an HMO, say with Sutter. And what happens is you go into Sutter, you have a doctor that's assigned to you, and you can only see doctors that are affiliated with that doctor's practice, or medical group, I guess would be the better word for it. So what happens is say that you have knee surgery, right? If you have knee surgery and you're with an HMO, they might say, hey, let's try some more physical therapy before we get to surgery. If you have a PPO, which is a like preferred provider network, you can see any doctor contracted in the provider network, the preferred provider network, and you can have a little bit more, like dictate your care a little bit more, where you don't need to always have a referral to go to a specialist. You can see a larger network of doctors, and you have the opportunity, you could go to a doctor outside of network, but that would be really costly.
So,
Another way to think of it is that with a traditional HMO, so say it's I'm thinking like not necessarily Kaiser, but I'm thinking, say, Sutter as an example. The doctors are paid a monthly fee out of the premium that you pay. So my understanding, and while I've had people have great care with HMOs, is that, they only make the money that they're paid. With a PPO, the doctors are making money off of every service that's provided.
and
I don't know if that helps or not.
yeah, no, that helps. I was just trying to understand the difference between those. I mean, and then another question I have, maybe for somebody who might be listening to this, like, how do you know when you're ready to start offering benefits? You say there might be a certain requirement of people to buy in. So I'm assuming maybe you kind of ask your employees, like, hey, how many of you have insurance through your spouse, or do you need insurance? And then like, what kind of buy-in do you need? And then how would you go about shopping for somebody like yourself in a different area of the country?
Oh gosh, those are good questions. I think as the owner of the company is really getting a feel. I mean, it is a cost, and it is the benefit is something that you as the employer can write off. But I would
Mhm.
get the feel you might have employees questioning, or you might have a situation where you didn't get a new hire because you didn't offer benefits. So, and also, what is your need as the owner? And I think oftentimes it has been the owner of the company that has kind of dictated what they need, that has started the process. And so I would start by getting an overall feel from the employees. How many of you have benefits? What do you have? You, like I said, you might find a strong pull towards Kaiser, or you might find, more towards a PPO or a split. And then I would start, I guess, researching in that area who are insurance agents. I'm trying to think. I'm an independent broker, so that means I can represent any company out there. I'm not tied to one company, and I think that's the way that most insurance, major medical agents work. So I would put in a call to a general insurance agency. I think if you start working with, like, say, a State Farm or an Allstate, they might be more captive, and they may not do the major medical in comparison to maybe an independent agent, but it's always worth the call. The other thing that I do is that I work with a national wholesaler in California, so that I'm able to go to them, upload a census, which is the list of all the employees, their birth dates, if they have dependents, and I can put together a quote of maybe 10 different carriers all in one packet. And I can look at that ahead of time based upon our conversations. I can weed through it. So I'm not going to show you 100 pages, but I can narrow it down, take it to you. And then if you like what you see, or say you want to tweak something, I can go back and we can kind of rework from there. Um, as an insurance agent in my office, I do not charge for my time. I get paid a commission by the insurance that I place. So each month I'm paid a commission by the insurance company that I place the coverage with. But I do not charge for my time. So if I come out to do, employee enrollment meeting or work on your renewal, that's all part of the package of that we put together. I don't charge any extra funds for that.
So how does one find a
It's a
small person like you versus when you look up insurance? I would imagine you would tend to find larger insurance coverage and providers and things. And how do you know what I'm saying? Like, how do you
yeah.
find that smaller person in that big stack of people that have all those marketing dollars that are pushing out their big names?
The big names. I mean, you could start with like if you have a property and casualty agent, you could start with them that writes, more of your property casualty insurance. If you're in California, you could look like Covered California has on their website agents in your area. And I also often think referral, word of mouth, talking to other people. Well, let's see, my dad started the business well over, I think I want to say 1983 is when he branched on his own. And we've never done any advertising. Everything that we have done on our end has been word of mouth and referrals from one business to another business. So I would definitely talk to people, talk to other businesses, see who they're using in your area and what they like and what's included in their, in their service for you.
Yeah, and you can
Another
you can just look for a broker, right? Rather than just like the big box like insurance company or whatever.
You can. I don't. I think that individual coverage, it's very easy to go to the big box company and just get a quote online and go that route. If you were interested in one particular company, you could contact them probably in your area and they could refer you to an agent. Um, and the big thing with, well, and again, this is California driven, but when you start looking at benefits and the pricing and different carriers in a small group, it's cookie cutter. So whether you went to me or you went to another agent, those rates should be the same. There shouldn't be a difference. It's not like a big, like large corporation where maybe they are, independently insuring some of the benefits. So maybe they have a $10,000 deductible, but the employee only sees 1,000. You don't have that. It's very cookie cutter, regardless of whether you go direct, you come to me, or you go to another agent.
Okay, good to know.
Yeah, but and then there's, that's just the medical. There's other pieces too. I do know like payroll companies will come in if you have, if you use outside payroll service and they have benefits now. One of the reasons why you might use them is either to do all of your benefits, or you might use them if you decided to set up a Section 125 plan, a cafeteria plan. And that is set up in order for an employee to be able to pay their portion of the premium on a pre-tax basis. So that's great for them because it's not, affecting their income, and great for the employer because it brings down their taxable income as well. So there's a couple ways. You can either use a payroll company and they will have a fee to set it up and you need the documentation. But then there's also companies out there, if you tend to manage everything in-house, where you can actually set it up, and if you do your own payroll, you can have all the paperwork sent to you that you need in order to be legit and to be able to offer the Section 125 to your employees.
I don't know that any of us are quite here yet. There's some people that are in the group that are not on the call that probably are for sure. But you say you like one of your customers is up to like 35 employees and stuff like that.
Mhm.
How do you know when you've gotten into a different tier or threshold of the amount of employees versus the proper person to take care of your insurance needs?
So I'm very honest. So for myself, I'm very honest about it. I would say 50 is about that number, because once you start going 50 and higher is when you're considered a large group. Um,
Mhm.
I feel that, like I said, like I really stick. I started kind of dabbling into the large group, and I just felt that there was, again, an expertise that I needed to have in order to do that. And I really like working with the small employer. So I would definitely, as you start getting up into the mid 40s, if you think you're going to be expanding, I would be really looking for an employee, like a agent that's experienced in the larger group business, because it's completely different.
What kind of tiers do they have? So you have small group, and then the next would be large group.
Large group.
What is that? Is that from there? It's just that's it,
Um,
essentially.
and it depends upon how large you are. So the you could have, say, you could have a large group benefit, say with like a Blue Shield or a Blue Cross, and you might be able to, as a large group, work with them more closely to negotiate the renewal based upon history and performance and how, how much was the plan used. And then I said, then there's another part that if you maybe have multiple companies or have a lot more employees, you might be looking at something where they use a third-party administrator. So it's where you design the plan with the third-party administrator. Maybe you're utilizing a preferred like PPO network with, say, like Cigna, and the employee only sees a certain annual deductible, but maybe deductible is like 10,000. So the employer pays out of pocket until they reach that 10,000, and then the insurance kicks in. And an employer would do that to bring down their cost.
This episode of the podcast is brought to you by glassgadget.com. Showcase Innovations creates tools that help shower door installers be more efficient and save time. Check out glassgadget.com for more information.
But again, that's like when you start getting into those much larger groups, and the expertise, I think, from the agent on that side is definitely needed to guide someone. And with that too, you would definitely want to you would have to have a third-party administrator for your federal COBRA to handle all of that for you, because I just wouldn't want to jeopardize anything going wrong and the penalties that could be put in place.
I have a question.
Yes.
Why does an employer have to pay for somebody's insurance when they go with their spouse's plan? To me, that makes no sense. Why I'd be paying an insurance company for a service that they're not providing?
So if you as the employer choose to pay 100% of an employee's premium, then they're expecting that all employees are put on the plan. And so that's why I would tell an employer, don't do 100%, do 95%, do 90%, because you would have to enroll everybody on that census, regardless if there's other coverage. So that's why I say.
Okay, so that's the determination there, because I thought that if you offered it at all, regardless of the percentage, that you would still have to pay. So I was misunderstanding that.
No. So I would definitely recommend not paying 100%, because if an employee's spouse has a better benefit than you, right, and their employer pays well, and there would be no reason for them to come onto your plan, and they're only coming on because you're paying 100%, it's not worth it.
Now, is that by state? In other words, would that vary to other states other than California?
It could vary from, outside of California, but I do, and it could also vary with the insurance carrier. So, you have, but I'm pretty sure, like every carrier that I've dealt with, and if you are paying 100% of that employee's premium, every single employee has to be listed on that plan and has to enroll. There's no option for somebody to choose not wanting the plan. And so that's why I wouldn't recommend that.
The reason why we have not brought insurance on as a benefit was specifically for this reason, because several people have spouse benefits that they would go with, and we'd been told that we'd still have to pay. And I don't think we were looking at doing 100%. I think we were going to do, like 50% or something of that nature.
Are you outside of California?
Yeah, I'm in Georgia.
Yeah, so I don't know what the law is there, but in California, if an employee has coverage through a spouse's plan, they are able to decline the insurance. There's a little section they have to complete, and it doesn't count against the participation requirements when the group is set up. when the employee, say they lose the spouse's coverage, then the employee gains the right within 30 days to enroll onto their plan without any penalty. They don't have to wait for open enrollment.
Good to know.
Yeah. So I know I don't know, but I could always ask through one of the large wholesalers I work with. But I think again they're going to be more, California based.
Well, that's fine. You've educated me enough to know how to ask questions, at least for brokers in our area. So
Okay, good.
for that, thank you.
You're welcome. We talk a lot about, major medical insurance and benefits for the employees, but I also think that as owners of companies, that there's other insurances that you may not have thought about. One of them being using life insurance. So, for instance, if you own a business and you have a partner, you might have a buy-sell agreement. So that clearly dictates what happens in the event that one of the partner passes away. Oftentimes, life insurance can be used as a vehicle, maybe to pay off the other family, your partner's family, because in the reality is you may not want to be in business, like I said earlier, with your partner's spouse, right? But you need the means to be able to pay to buy them out of the business. So that's one. The other one would be oftentimes there's disability insurance that's used for overhead expense. So say you as the owner became disabled. What happens now? Will the company be able to continue okay? Would you be able to, make payroll? Are there expenses with you being out that you would need to meet? So this business overhead expense would be a larger sum policy that would actually be paid to the company if you were considered disabled, that would provide an income to the company to be able to still be able to meet your payroll and meet those expenses so that either you had time to recover or the business had time to transition. So like I said, there's other insurance, and probably the other one that we did a lot with maybe back in the, gosh, I want to say it was in the 90s when it first came out, is long-term care. So what's unique about long-term care insurance, and I'm not talking group, I'm talking individual plans, is at that time you were able to discriminate, and you still can. It's a benefit that you can have the employer. You do not have to offer it to everyone. And what we did back then is the employer was able to buy a plan and they were able to pay it off in 10 years. So many of them would work, they would pay their premium, and by the time they retired, they had a fully paid up long-term care plan that they could take with them. The benefits from the long-term care were non-taxable. When they actually needed the plan later in life, it was there for them. So that's what there's different things, you can do in different opportunities as well with the insurance. Oh yeah.
I was gonna say, so like we have a guy that is out right now. He's gonna be out for multiple weeks because he has a broken collarbone. So you know how you were saying like if you pay 100%, then you kind of have to you have to offer that to the other people. So when they're out and they're not having any hours earned, but you as an owner want to keep their insurance
Yes.
paid, and so you temporarily offer like 100%, essentially you're offering 100% coverage for them because they have no hours to pay for their coverage, but you're still footing the bill. How does that work essentially?
Oh, that gets kind of into like a gray area. I think first and foremost, when
Like
you
this?
kind of like, so when you start offering to cover benefits for someone when they're out of office for that period of time, I would definitely say make sure you have an employee handbook, right? That explains that, because what you do for one, you're setting the precedent that you would have to do for all. So an employee handbook would be great to have that spelled out. Sometimes employers will say, all right, you're out for so many months, we'll cover it. Or they might have the employee pay part of the premium or their portion of the premium still. What I have found in California is the insurance companies take a step back and they don't want to be involved. So you can continue to have the employee on the plan, and it's up to you as the employer. Now, if you're a small group in California, this doesn't necessarily work to the employee's advantage, but if it was financially, you didn't know how long this was going to go on, and you could have them removed from the medical plan and go on to Cal Cobra. And then when they were eligible to come back, you could bring them back on as an employee, right? And back onto the benefits. Keeping them on for a period of time, I think you just have to establish how much are you willing to eat as the employer, how long you're willing to do it for, and do you have anything written so that they're aware, or the employees? Because I tell you, if the employees start talking, then it becomes an issue.
Yeah, that's actually a good thought. Yeah, I don't think we have it written, and this is the first time we're experiencing it with a non-family member employee being out with some issue that has the coverage being taken care of. So,
How
yeah,
long
this
do,
is setting precedent.
how long do you think they may be out for? Or you
It's a
don't know?
collarbone break, so it's going to be anywhere between 6 to 10 weeks, I would imagine. But they'll probably
Okay.
come back. I mean, he's getting bored already, so he's going to come back as light duty and stuff,
Okay.
and just do what he can to a certain extent. You know, he's itching to get back to work, but we have to keep him away as much
Keep
as we
them away.
can.
So, and Adrian knows, so my husband is actually in window sales, and that's how I actually met Adrian and Junior and their father, Octavio, is that was his client. And so I'll use an example with my husband. He had left one company to go work for another company, and it had only been, maybe 8 months. And we're talking the crash of what, when did the market crash last? That was at 1997. And that time, no, yeah, 19 in the early 2000s when it crashed. And he went in, told the new employer, he'd been working there for a while, said, I need to have knee surgery, goes in for knee surgery. It was going to be in and out, not even with crutches. Well, he ended up having complications. So his initial plan was to be out starting on a Thursday, coming back Monday, fully fine. He had major complications. His thigh ended up atrophying. Ended up out of work for quite a long time. And so, they paid the benefit for a bit. Then we had to start making our payment for his portion, which so I'd send them a check. And so this surgery was in October. And then I want to say it was by January, all of a sudden it was kind of like, okay, well, now we'll take back the computer and do this. And so we said, are we being let go? And he said, no, but they used it as an opportunity to ultimately restructure, because it was, the economy had just completely crashed at that time. But like I said, they gave us a certain period of time. I want to say the first 30 days. And then after that, I was responsible to pay the employee portion of the premium that I wrote back a check to the company. And then I want to say we were moved to Cobra by January. So that was only about 3 months.
So, I guess that asks a question. Are we just too nice, or do we just not know of state benefits that they could be utilizing other than just utilizing our um, being nice kind of thing? You know what I'm saying? Like,
I
what
do.
is there to fall back on instead of just falling back on being a good guy and keeping people insured?
The only other alternative in this situation, if you're not going to let them go, is to have them go off of the group plan after a certain period of time. And then if they're in California, they would be eligible for Cal Cobra, which would extend, they would be eligible to have benefits for another 18 months. But they would be paying 100% of the premium. So you as the employer, if you see what you're paying for their premium, you would know they'd be responsible for that and maybe a small percentage more. But when they were cleared to come back, they could come back, to the company, and then you could see if the carrier would waive their, the waiting period again, like the first of the month
Mhm.
following 16.
Yeah.
So, but that's the only thing I can think of. And if they're
Mhm.
eligible for Cobra, they're not eligible for Covered California, which might be a plan they could have done if they're not making income,
Yeah.
or a reduced income for the year.
Do you have any suggestions on disability insurance for owners or employees?
Oh, I think disability is probably right. I think it's one of the best benefits that you can have. I do. If you can get and I would have to see with your industry how it would go, because the disability insurance for small groups is priced by industry. But if an employer can offer some form of long-term disability, it is so expensive in the individual market that you're paying a fraction of the cost for a plan through a company. And I mean, if it were me, I personally would rather have disability insurance over dental insurance, because that's the one thing that's going to protect you if something happens. And that's the same whether it be like the owner of the company or an employee. So I think I said, I don't know if I was on with everybody, but I did have an employer. She was a doctor and she had her own business, and she was out riding, got bucked off the horse and ended up getting kicked in the head and became completely disabled from that point on. And if she didn't have her disability policies, I think her family would have been financially ruined.
Wow.
Disability insurance, when it's through a company versus individual, if it's something that happens obviously not through the company, that's when it's covered, right? Like, so say like you're out on your own time and that's where the disability kicks in, right? Otherwise,
Correct.
it's workers' comp essentially kicking in.
Correct. It would be workers' comp versus,
Okay.
long-term
Yeah.
like the long-term disability. Yeah. And there's two different types. You have short-term, which is more, for a shorter period of time, and the long-term. But I would say the long-term is what's really going to protect somebody, because you just never know whether it be a car accident or just an accident in general, or you become sick. So. I'm trying to think, and then there's other, as owners of the business, there's, different types of life insurance policies now. So you have a lot of different policies that could provide a benefit to your family. There's policies that have long-term care tied to them, whether it be a rider or what we call a hybrid product. So definitely one of those things to think about if there's ever a need within a company to maybe, maximize expenses. That's another option as well.
Hey, going back to that life insurance, so you were talking about, having an insurance policy on a partner or something. You need to buy out their family
Yep.
situation. So now you can get life insurance on any valuable member of your team, right? So even like
Correct.
let's say you've got an employee that's a manager and is super critical to your business. If you lost that person suddenly, I mean, it would be expensive to manage without them.
Correct. Yeah, that would be labeled, that's key person insurance. And I have, a lot of companies that will have that on, employees. Because you're right, you lose an employee and now all of a sudden, what were they responsible for doing? What sort of loss? How long is it going to take to replace them? And what sort of income hit are you going to take as the employer? So definitely there's, key person insurance, which is basically to help offset that type of loss. And then you have more of like, if there's a partnership and you have a buy-sell agreement that you've done with an attorney, well, okay, you have the piece of paper and you have the document, but if something happens to one of the partners, how do you pay for that? Right? How do you pay to buy out the other family and buy out their shares in the value of the company? And that's, that would be done either with a life insurance policy, or they even have disability, policies that serve the same purpose. If you were to become fully disabled, that it would be there to pay out the partner in the event that you became disabled and maybe you're going to sell your shares. So there's definitely ways, I think, to protect you. Then there's, the business overhead expense, money to come in if something happened to you. Okay, maybe you're a single owner of the company. What happens next? What's the plan to transition if something ever happened to you? Will the company still have the monies coming in that it had before? And how do they keep it going? Or will it dissolve? So there's all different uses for, I think, life insurance and disability insurance to help protect you as the owner of the company.
How would you keep that life insurance policy on your business partner up to date with growth if you're in a growth trajectory?
Yep.
And their buyout as you grow, their buyout is obviously going up, but this plan you have is you bought it when you started and it's at a lower buyout, like how do you keep that to where you can keep increasing it to the current value of the business?
So sometimes we do a blend between like a key person and what am I thinking of? A key person policy. So it plays two parts. It might be for buyout and it might be for key person. So it's hard because most products don't increase like that. They don't gradually increase. And so it really comes down to putting the right amount in place at the beginning, seeing how much, because it's all based upon your books and having to, provide a financial report to the carrier. And then at different periods of time, reviewing it, taking a look at where you're at and maybe having to add a new policy or replace the policy that's in place right now. But again, if it was a key person policy, you just have to remember that employee is just the insured. You, as the corporation or the business, you're the owner of the policy and the corporation is the beneficiary of the policy. So if something happened to them, that money is then coming into the company. But definitely I have companies that we have to do periodic reviews and see, okay, where are we at right now?
Yeah. I think you answered the question there. You would actually probably just continue to add policies in addition to the existing ones and making sure that when the existing ones lapse, that you have new ones in place to fulfill it, right?
Well, and there's there's different life insurance products. So you have term, which you're picking like a period of time. It's like car insurance, but you're
Yeah.
picking a period of time where the premium remains level. But when that term is up, that insurance is done. So sometimes I have employers that do a mix between term and universal life. So term is definitely less expensive than universal life, but universal life can actually provide you that longer period of time to be able to cover an employee or to cover, or yourself.
What's the
Can provide
shortest amount of term life you've ever heard of?
I think you can go down now to like even like 1 or 2 years, a 5-year term. It just then depends upon what carriers actually sell it. It may be more limited. I would say most carriers sell maybe 10-year terms. So when you go to run a quote, the carriers that I work with, I use a wholesaler for that too. And I'll have a list of carriers. Not all of them are like, will sell at 500,000. They might sell at a million or, or even the lower amounts at 250. They might just say, no, we're hands off there. So I would say, I would say you could probably go down to like a 5-year term or a 10-year term and then just cancel it for what you don't need.
What if you're single ownership and your business has, let's say, 10 employees? If something, and I'm the example here, so if something happens to me, insurance really isn't going to help that much.
No.
Unless you have some kind of idea there that,
No, insurance there isn't going to really help you unless you had a plan in place for somebody that would step in or that maybe had been with you a long time, that and you have it written up that would take over the business. Definitely everything would have to be in writing in advance.
Yeah.
A transition
that's going to be real tricky because then basically the ownership has to change also somehow. And but certainly you could have some ownership to maybe, insurance so that whoever is the beneficiary of that would be able to maybe buy the company and pass that on to the family. So
you could, and
something
that's typically what you would see more in a buy sell. And so sometimes the life insurance is determined based upon the shares, or sometimes there's just different ways to design it where maybe there's like a cross purchase, there's flat amounts. So definitely something in your planning and thinking ahead of like, okay, what would happen? What would I want to do? Would the business just close? Or is there someone that I maybe want to start considering that would take over if I were to, if something were to happen to me?
Hmm.
Those are tough ones. It took a long time even for my dad. So I worked with him starting what 90, I think it was like 92, 93, and he worked with him for a long time. And it was very hard even as he started transitioning to retirement to start kind of handing over pieces. And it wasn't really until he got sick that he really was like, okay, I need to step away. But we started really then talking about it, like, what is the plan? What should I do if something happened to him tomorrow? Who am I calling, to be able to keep this business going? And I had been around long enough, I think at that point, so it was more, him. But once he got sick and we knew that there was a time frame, we really started putting things in place, adding me to the bank account. There's just a lot of little details that you have to take care of.
Mm.
And,
Yeah.
and then too, I think it was also building a relationship with a lot of, different clients that I hadn't, that I didn't work as closely with too. So it was a process. It was definitely a process.
And one other thing about that, like key person
Mhm.
policy. So do you need to have that person sign off somehow on a policy, or can you
Oh
just
yeah.
policy?
No, you have to. So what happens is that the company is the owner, and the beneficiary, right? The employee is the insured, but they're the ones that has to go through all the medical underwriting. So not only does the application have to be, some of their personal information has to be on that application, it's all of their medical questions. They
Okay.
have to go through an exam with their labs. So they do sign off that they know that this policy is on them. And that is a requirement for them to sign off and acknowledging that there is a policy on them that they have no buy-in to.
Yeah, because I remember kind of like in the old days, tell me if I'm wrong about this, but it seems like back in the olden days, you could just take out a policy on anybody back before they ran all these checks. I mean, it used to be you could just
Correct.
buy insurance, you didn't have to get an exam or anything like
Yep.
that. So you could just take out a policy and they would never even know you had it.
Well, it was easier, and if you go back, the whole reason why the insurance company started doing exams was actually because of HIV. But what they found out is by doing the blood tests, is then they found out, well, wait a second, there's all this information that we can gain, about somebody just by through a simple blood test.
Oh yeah.
So the requirements are now that you do have to sign off and agree that you understand that an employer has this policy on your life and that you have no interest in it.
It probably should be that way anyway, right? I mean,
It should be. And I do have, employers that have the key person. And then along with it, I have some employers that have, a basic, like say 500,000 15-year term policy on all of their key employees, where they're not the owner and beneficiary. It's just a benefit that they provide. And the employee can name who their beneficiary is.
I wanted to see if you could give a quick take on your opinion of supplemental insurance through work.
For instance, like an AFLAC or
Like we had supplemental insurance through a Global Life or whatever, but I find it a pain in the ass and not necessarily worth the trouble. Like I could go get my own, and you know what I'm saying? Like what is your opinion on supplemental insurance? Because we offer it and we have it, like some things, but it's just, is it really worth it, Or
So,
can
I
you
mean,
get better?
so if you're talking more like an AFLAC that would maybe offset some of the costs, like if somebody is going to like the hospital and they have hospital charges, is that what you're,
Mhm. Yeah,
okay.
we have like emergency disability
Yep.
or like emergency and accidental and all sorts of weird things and small minimal life insurance things of a small amount that they offer and the weird little things.
Um, I have not sold it. I did at one point look into selling Aflac years ago. I do have one company, but they had already had an Aflac agent, and but it's a motorcycle dealership. So they were very happy having that supplemental insurance. That was something that was really driven by the employees, and most of them had it. So I think it became like a word of mouth. But I don't believe I have any other company that has
Mhm.
supplemental insurance.
Yeah. Seems like it would be more worth you just individually going to get your own plan versus doing it through
If it's
the way it seems like.
And I think that I want to say United Health just came out with like a supplemental plan that we just got word of this week, and I haven't looked that much into it. But if you have a good medical plan, um, that should be enough. It's just that oftentimes employees will use that to offset, so they don't have to pay that deductible. They get reimbursed. So I think again, it depends upon your employees. Like if it's something that they utilize, then I would maybe consider keeping it. If they don't, then I wouldn't do it.
There you go. Yep.
Truly driven. I think that one's truly driven by the employees.
Nice. Well, Debbie, thanks again for joining us.
Well, thank
That
you.
was really informative. And we're from all around the country, but there's a few of us right here that are in California. Tim is here in California. Of course, Adrian. And
Yeah.
so if one of us wants to get in touch with you and talk to you, what's the best way to do that?
You're welcome to give me a call. I've got my phone number I can provide to you. If you want me to provide it now, the office number is 925. Oh no, I'm sorry, 916. What am I thinking? I'd never call my office number.
You're on the spot.
916 I know 916-259-1482. You can also shoot me an email at Debbie@D as in David, F as in Frank, T as in Tom, insurance.com. And if you don't remember, then you can ask Adrian.
Yeah.
I got it.
He can connect me.
I'll also put it in the description, so that
Sure.
people can reach out to you if they need to.
No, I appreciate it. If anybody has any questions, please feel free to give me a call. I kind of try to cover, a broad spectrum. But, as I said, if anybody wanted to see any quotes, I don't charge for my time. I'm happy to, answer questions, provide quotes, even if you're just not even sure. You're not committed.
That's really nice. You did a great job. I mean, you covered a ton of stuff. So
Thank
thank
you.
you so much for taking the time to do that. And hey, be sure to join us again next week at the same time. We're going to be talking about customer service and experience, how to create a positive customer experience, how to handle customer complaints, and build customer loyalty. So it's going to be a great call. Once again, Debbie Ruiter, thanks for joining
Thanks.
us.
Thank you.
Yeah, everybody have
Thank
a
you, Debbie.
great rest
Thank
of
you.
the week.
See you, Debbie.